Welcome to Market Call. We are talking real estate today. I love these specialized Market Call shows. Andrew Moffs of Vision Capital is here to talk about real estate investing, REITs and equities. Andrew, thanks very much for joining us. I'm right in saying that you're game to take questions on real estate equities and on real estate trusts today.
Absolutely. Looking forward to it.
And I mean, give us your view overall. I know interest rates are the driving force for real estate investing. It's got to be a good environment in the sense that borrowing costs are near zero.
Absolutely. I mean, if you're a private buyer, I'll give an example. If you're a private buyer of apartments in the U.S. Sunbelt today, you know, this states like Texas, if you're buying apartments in Dallas, 6 months ago, you would have gone out for financing. Today, it is substantially lower. For the very same asset, very same loans to value. So we're actually starting to see the onset of yield compression in cap rates, meaning that the values are actually going higher in certain assets where you can actually underwrite the stability of the cash flows and you have strong macro fundamentals.
I guess the other thing, and I know we'll touch on this, but the other side of the coin, though, is worries about the future of retail, and of course rental in some markets that may have become inflated.
Absolutely. I mean, that's my comment about the ability to underwrite the stability of the cash flow. So if you're a private buyer today, you're going to make a bet on those sectors of real estate that should be stable, that are winners post the pandemic. So think industrial warehouse, the opposite of brick and mortar retail. Think apartments in affordable parts of the country, both in Canada and the United States. Think single-family rental homes across the United States, where now people can work from anywhere and looking for a bit more space. Those are areas where the cash flow is very stable, and the macro is strong. Retail, office, student housing, those are examples of sectors where we question the stability of the cash flow. Certainly, these are asset classes that will remain, of course, but the rents we underwrote a year ago are not the rents we're going to underwrite a year from now.
Andrew, let's leave it there. We're really looking forward to this show. We're going to hear about real estate investing. Andrew Moffs of Vision Capital is taking your questions. The number to call, 1-855-326-6266. So we're talking real estate, investing in REITs and real estate stocks today with Andrew Moffs. The number to call, 1-855-326-6266. Let's kick off with an email from Hal in Victoria. Wants to know about Morguard North American Residential REIT, MRG.UN. Hal says it's been weak. Is it a buy?
I think MRG is a hold. It certainly is a value name in the apartment space. It owns a portfolio of apartments both in Canada and the United States. Been very impressed with the stability of the Toronto portfolio. Their apartments in the Greater Toronto area have really shown their stability through the pandemic and held occupancy quite well without the use of incentives, so that's a positive. They are in some select markets across the U.S. Sunbelt. Some are stronger than others, as well as some exposure in Chicago. It's a stock that has higher leverage. So we're trying to find companies today that are more defensive, and both you combine an external manager contract on the REIT as well as higher leverage. It's a stock that sure is very defensive, but at the same time, we don't see the same growth profile that we see in other apartment REITs that we own.
Right. Why do you think the growth is likely to be weaker for Morguard?
Some of their markets are more secondary and tertiary, and thus are not garnering some of the rental growth that we've seen in some more prime U.S. Sunbelt markets.
Another question about an apartment REIT. Mina has sent us an email. What do you think of Killam Apartment?
Yeah, we think highly of Killam. We like the management team. We like their strategy. They are a dominant owner in Atlantic Canada across the Maritimes. They've expanded west here in Ontario, as well as they've entered British Columbia as well, and have a small presence in Calgary. As I said, we like the company. It has performed better than some of the apartment REITs because they lack some of the more urban exposure that has caused some of the urban-centric multifamily REITs in Canada to lag. Thus, if you own Killam, I continue to hold it. I think they should continue to show stability and same-store NOI growth over the next year.
That's interesting. So in urban centres, we've seen rents coming down. Is that partly because condos have been coming onto the rental market in a big way?
Absolutely, yeah. With travel restricted to Canada, filming not going on, things like that, students not coming, foreign students. You've seen a lot of product that used to be rented out through companies like Airbnb now return to the regular rental pool. These rents have typically been much higher and thus not competitive with a lot of the multifamily apartment REITs in Canada. But that spread is narrowing as some of these owners are trying to garner whatever rent they can. So on the margin, we've seen incentives being used for the first time in really my career, used here in the GTA for some of the higher end apartment REITs, just trying to compete with some of that new condo supply.
That's interesting. Students not here from abroad, Airbnb drying up, and movie filming. You wouldn't really think about that, but that's obviously a source of rental demand. Yeah, an interesting theme. Stephen in Calgary, go ahead, please.
Yes, hi there, Andy. First-rate show. Andrew, I wanted to get your opinion on the valuation currently of InterRent. Do you find it attractive? Is it discounted? And not long ago, real estate apartment REITs were looked at as the new gold. Do you think that kind of hard asset mentality will come back, especially to pension funds? Thanks.
It's a great question. We are bullish on apartments long term, no doubt. You definitely have an imbalance of demand and supply in many markets, and here in Canada, that continues to be the case. Short term, you're going to see some impacts. I alluded to that, and you asked about InterRent. They have a nice growing presence in Montreal. I really like their portfolio. I've toured a majority of their assets. They do have assets, though, near the universities of like McGill and Concordia that have suffered as a result of foreign students not attending this year. So you will see some short-term pain, and thus the gold standard for some of these apartment REITs. You're not going to see it this year. You're still going to see defensive cash flow. But, for example, in Ontario next year, the Ontario government has come out and said there's been a rent freeze. So on renewals, you're not going to see the rent increases. We don't believe that's an impact to the net asset values of these companies longer term, so long as there isn't any further changes to rent regimes across the different provinces. But that's a risk you run. But longer term, like I've said, I think this is a great asset class, very defensive. Rare in my career you can buy some of these blue chip companies at discounts in net asset value. So if you're a longer term investor, now is the time to think about adding to these stocks.
Wow, lots of interest in apartments today. Carl in Toronto, go ahead, please.
Hi, Andrew. Thanks for taking my call. And to the other Andrew,
Pleasure.
I think we're all on the same focus this morning. I'm talking about CapREIT, which I would sort of consider in the same vein as InterRent, and their stock price has really taken a hammering in the last 3 months. And I think some of that rationale was there was concern that you wouldn't be able to collect rents in the middle of COVID with people short of money. But if you look at the rent collection rates, they're actually very good. And in the case of CapREIT, they're collecting 98% of their rents. So again, I'm viewing this as a category where there's been perhaps unfairly punished from a stock price point. And I'd appreciate your views of that company, CapREIT, going forward. Thank you very much. Stay safe. Cheers.
I certainly agree with your comments. CapREIT is blue chip management, great portfolio. I think this is a company you definitely want to own. It is pulled back to a level that's heavily discounted. any near-term concern, in our opinion. And you're buying out at a healthy discount to net asset value. And what does that mean when I keep saying a discount to net asset value? It's the ability to buy real estate cheaper in the stock market than the private market. And so just take a deal that's in the market right now in the Midtown Toronto market. There's two assets on the market for sale, very comparable to assets that Canadian Apartment REIT owns. The cap rate that it'll probably trade at is in the low 2% range. If you apply a cap rate like that to cap REIT, the value of that stock is in the 60s, and you have the ability to buy that stock today in the 40s. So the private market is saying, we believe in long-term value. The public market's trying to discount the future, but we think it's overly discounted it. And I think here's a great opportunity to buy an enterprise like cap REIT. Not to mention 15% of their portfolio. You have exposure to Europe in the Netherlands and as well as in Ireland, which are great markets from a demand and supply perspective. And they have the largest portfolio of manufactured housing communities across Canada. So as you can tell, we're pretty bullish on this stock.
So the cap rate is essentially a yield from a property?
Correct. Yeah, I like to think of it as the inverse of a multiple. So the lower the cap rate, the higher the value of the property. And it's that first year cash flow you're going to get from the property, very similar to the coupon on a bond.
Okay, we're going to take a break. Andrew Moffs of Vision Capital is taking your questions on real estate stocks and REITs. 1-855-326-6266. Let's head to Vancouver. Peter, go ahead, please.
Oh, thank you for taking my call. As usual, great show, great host, and great guest. Andrew, one of my favorites.
Thanks.
I'd like to ask you about HOM.U. It was it went up a high at $13, $13.50, and then it keeps on coming down. And has been recently acquiring properties, seems to be very accretive. Can you shed some light? I hold it, so should I buy some more? Thank you very much. And
Okay.
to one of the best.
So that's BSR REIT.
Yeah, thanks for the call, Peter. We are very bullish on BSR REIT. It's actually a stock that is one of our top picks. This is a company that listed on the Toronto Stock Exchange, owns exclusively apartments across the U.S. Sunbelt, with the majority of its owning of its apartments in the state of Texas, Dallas and Houston and Austin. We've toured every one of their assets. Management is really top-notch, highly aligned. They own half the company. And this is a company that trades at a material discount to its net asset value. That's not a surprise to us. Often we find that companies like this that own U.S. assets listed in Canada are not valued in the same way that other Canadian properties are valued in Canada, simply because people are not familiar with the assets. But all we have to do is look to the private market. And we see comparable assets to BSR REIT trading in the 4 cap range. This is a company where you can buy it on the Toronto Stock Exchange. It had an implied cap rate in the 5.7% range. Said differently, I think of this stock in U.S. dollar terms. So it trades at, call it $9.80, $9.90 in U.S. dollars. It's easily worth north of $12, $13 if you apply those metrics. So we continue to own it, and we think it's a buy at these levels.
Let's head to Calgary. Ram is on the line. Go ahead, Ram.
Could I please have your opinion about HHC, Howard Hughes Corp? This is real estate which is selling at half the net asset value of the stock. In your opinion, is it a value trap or it's a good investment? Thank you, sir, for your opinion.
Yeah,
thank you.
So the Howard Hughes Corporation, listed on the New York Stock Exchange, is going through a bit of a transition. They've now they have their third CEO in the past year and a half. They own a collection of assets across the United States. We call them the Big Six, where they own predominantly master plan communities. For example, Summerlin in Las Vegas, a dominant master plan community in that market. Woodlands in Houston, if you've been to Houston, this is north of Houston. It's really just an oasis north of the city, and we think it's a great development. The stock is cheap. It trades at a wide discount to net asset value. I think it's probably trading in the high 50s, low $60 range today, easily worth $120 based on comps from a year and a half ago. What's different today is they have a commercial assets, including office buildings in Houston. The future value is difficult to determine at this point, but where they do benefit is they own lots. They own housing lots for single-family homes. I mentioned Woodlands. There's another community, Bridgeland in Houston, that is very attractive and selling homes at a brisk pace. What's difficult in terms of crystallizing the value in this company is you have to find a private buyer that can take on $6 billion worth of assets that aren't necessarily cash flowing today, but have intrinsic value that will cash flow tomorrow. And so it is, I wouldn't call it a value trap necessarily, but you have to have a bit of a longer term view and hope that the value gets crystallized over the next couple of years. In the meantime, there's more defensive companies that you can own that perhaps might even have better near-term growth.
Ronald in Toronto, go ahead. You're on the air.
Hi, thanks for taking my call. I'd like your thoughts on Sharkwell residential retirement residences. Sorry. What do you own it, and what are your thoughts going forward into the year?
Yeah, so Chartwell is a company that operates in the retirement home sector across Canada. They're the dominant owner and operator across the country, and we think highly of management. They've done a great job navigating through a very, very tough first half of this year. All operators have. And as well as they do have about 10% of their portfolio in LTC and long-term care homes. The stock has suffered along with its peers. It's very difficult in terms of the near-term outlook to say the business has fully stabilized. We're pleased with in terms of occupancy rates for that company. We thought they'd actually be lower, and they've done a great job of both keeping residents safe, of course, but as well as keeping occupancy stable and only coming down a few hundred basis points as opposed to something much more material, which quite honestly back in March looked like that could happen. At this point, it is trading at a discount to its net asset value. It's attractive. If you own it, I'd continue to hold it, though you're going to experience likely some choppiness over the next few months, maybe quarters, as we go into the second wave. There's going to be difficult headlines ahead. You just have to withstand that and know that the value of the real estate is still there, that this is a good operator, and they're at least well suited to navigate a tougher environment.
Okay, we'll take we'll take a break. We'll have a look at Andrew Moffs' past picks next. You're watching Market Call. Andrew was on our show June 25th of last year. His first idea, Tricon Residential, 25% return.
Yep. So it was actually this year, a few months ago. In terms of Tricon, it's a company we continue to own. They did a financing led by Blackstone, the large global private equity firm, $300 million preferred investment, which was led by Blackstone. We had the opportunity as a fund to participate as well. This was a great vote of confidence for the company. The company is a single-family rental home operator and owner across the United States primarily. And this Blackstone was actually at the forefront of consolidating this industry coming out of the financial crisis and had recently exited the business at the end of 2019. This marks their re-entry and a great validation for both Tricon and the business. And as a result, the stock has rallied.
I wonder will there be political heat though on privately owned rental housing? The New York Times, the New York Times in March had an article entitled "A $60 billion housing grab by Wall Street," and they said hundreds of thousands of single-family homes are now owned by giant companies, squeezing renters for revenue. Do you think there could be a backlash against big companies buying up rental housing?
Well, it's certainly a very promotional headline. The reality is it's a transfer from mom and pop owners to institutional holders. With that comes often better service. And these companies are adept in terms of customer satisfaction. What does that mean? They do things, for example, digitally. They offer smart homes, whether it's thermostat or locks digitally. If you have an issue in your unit, instead of having some third-party off-site manager, maybe even the owner of the home is a foreigner, isn't necessarily in the city, out of state, etc. You have someone to respond to any sort of if you have a problem with the water, with the heat, etc. So we've actually seen higher customer satisfaction scores from many of these institutional owners. They're simply providing a better product at a time where the product is in demand. And so as long as they, if you look at their track record throughout the pandemic, they voluntarily decided we're not going to increase rents on our residents. We're not going to charge late fees, et cetera. So I think they've been good citizens. Most of these companies follow good ESG principles, et cetera. So I certainly makes good headlines, but I think they've shown that they're good operators.
European residential REIT, this one, a return of 3%. Do you still hold it? Would you buy it again?
We continue to own it. I think it's certainly a great buy. You look at the landscape for apartments globally. This company is focused on the Netherlands. The third densest country in the European Union. There is a housing shortage in the Netherlands, and what I highlight when I compare it globally, this company is able to achieve 4% rent growth. That's not going to be achievable in Canada and in many markets in the United States. There is rent control there, but the company's great at navigating that regime. And in terms of the flexibility within it, as I mentioned, that type of rent growth is pretty attractive. Mm-hmm. So it's a company that trades at a discount to net asset value, and we think it's a great buy, very defensive.
And then finally, Granite REIT, a return of 15%. Just remind us what they specialize in, Andrew.
Yeah, so Granite REIT specializes in industrial warehouses. This is a sector that has benefited from e-commerce penetration as a percent of retail sales. If you look at who's hiring this year, it's Amazon. If they're going to hire 10,000 new workers, where are they going to work? They're going to work in a warehouse. Mm-hmm. And owners like Granite is providing those facilities. So we like Granite. They have a tremendous balance sheet, very low leverage. What does that mean? They have the ability to go out and buy facilities today, take advantage of their cost of capital and make accretive acquisitions in this space where we think there's been a real secular change, where I go back to what I talked about at the beginning of the program. You want to underwrite sectors that are going to have stable cash flow, stable and growing cash flow. And this is definitely that type of sector. So long as you don't think that e-commerce as a percent of retail sales is going to go the other way, and we certainly do not think that. There's been, whether you think of stats like redundancy in terms of companies no longer holding just-in-time goods, they're going to want to have some backup in terms of look what happened with masks earlier this year. Countries couldn't depend on other countries for delivery of N95 masks, just as an example. So the whole supply chain has had a whole reboot, and that's perfect for industrial warehouse. So Granite, owners of warehouse both in Europe, Canada, the United States, they own Modern Logistics, and that's what we're a fan of. And it's a company that still has a bit of a valuation gap relative to its peers, so we continue to own it.
We'll leave it there. Andrew Moffs is our guest today, talking real estate and REITs, real estate equities, 1-855-326-6266. We are back. Andrew Moffs is taking your questions on real estate. John in Toronto leads us off here. Go ahead, John.
Yes, I'm calling about Choice Properties, and I had owned Canadian Real Estate Investment Trust. When the company was bought out, I took the Choice Properties. First of all, is a distribution safe? And secondly, I understood that the management team from CREAT came over to Choice Properties to manage it. Are they still in place, or have they moved on? And what do you think of Choice Properties' strategy to go forward? Thank you.
Okay, thank you.
Yeah, so Choice Properties is a diversified REIT. I think I want to say about 80% of its assets are retail. What's great about that, whereas we typically shy away from retail, is that over half those rents are backed by Loblaws, its majority owner. As we've seen through the pandemic, those are the type of tenants you want to have. The grocery anchored, pharmacy anchored assets have shown high stability, great rent collections. In terms of your question, yes, the management team from CREAT came over in almost like a reverse takeover of Choice. And we think very, very highly of both Rael Diamond, who's the CEO, and Mario Barrafato, who's the CFO. So I think the company's in good hands. The distribution is safe. As I've mentioned, when you have a majority owner that's paying a majority of the rents, and they are in a defensive industry, you can count on those rents. And I think the company is doing good things in terms of capital allocation, whether it's been developing apartments in Canada, owning industrial, just to diversify a bit of the asset mix away from retail. So if you own the stock, I'd continue to hold it and feel pretty safe about that distribution yield.
Larry in Toronto, go ahead, please.
Hi, Andy, can you hear me? Because I called on the wrong phone.
Hi. You're good.
Am I
go
coming
ahead.
through?
Yes, you are.
Okay. I realigned the portfolio. Early in the year, I got rid of RioCan and First Capital Realty. I kept a bit of Dream Office REIT, but I didn't sell any artists. So my question is on artists. I've heard they're getting rid of some of their commercial items. And they're sticking more with residential. They're in Canada and the U.S. Can you give me an idea what the current dividend is? And I know they pay monthly. And is the dividend safe? And what do you think of it? I'll hang up and listen.
Okay. Thank you.
So Artist REIT is going through a bit of change, as the caller mentioned. They intend to spin out their Western Canadian real estate retail assets and become an owner of office and industrial in North America. That transition will occur in terms of the spin out. You will receive units of this new small cap REIT, which might be difficult to value, might get sold by investors that receive it. And then the hope is that the office and industrial REIT will then see a re-rating in terms of its value, such that the sum of the parts is greater than the stock price today. I think the strategy, spin-outs on their own don't really create value. So you'll have to look at. We'll only be able to evaluate this in the rearview mirror a year and a half from now. It's a stock we at this point will likely would not want to own through that spin, but might present some value post-spin. They do own some good assets in the United States, industrial assets. Think markets like Houston, Texas. They own office buildings in stable markets like Minneapolis, as well as Madison, Wisconsin. I can't necessarily tell you that those are markets that will show much growth in the future, but at least up until now, it's been quite stable. So it's a stock that I believe the distribution yield is probably in the high sixes for now. I think that's a safe bet. I know they cut it over a year and a half ago. I want to say maybe 2 years ago at this point. So if you own it, there's a lot of things to consider as you go into the new year in terms of that spin out that will occur.
Mm-hmm. Tim in Barrie, Ontario. Go ahead, please.
Yes, good afternoon, Andrew and Andrew. I'd like to ask you about Dream Hard Asset Alternatives Trust, symbol DRA. We bought it about a month ago. It's come down a fair amount. We're wondering, looking forward, what you think.
Yeah, so this company's a little different.
Sorry, Andrew. I think, was there a mix-up there? You weren't... were you expecting to talk about another Dream asset, or just clarify for us? Sorry.
I'm pleased to talk about any of the Dream entities. This one...
okay.
If the caller was talking about DRA, Dream Alternatives, it's a smaller cap company. It's not a real estate focused company, but it's managed by a public company called Dream Unlimited, DRM, which is the asset manager of other publicly traded REITs like Dream Office, Dream Industrial, which focus in their namesake asset classes. Dream Alternatives, smaller company, been focused on either renewables, energy, as well as owning interest in some of the office buildings that Dream Office REIT owns, as well as they have a growing land base in the GTA for condo sites. It has traded at a discount to net asset value. I know they've pursued different strategies, whether it's been a substantial issuer bid to try and close the gap. At this point, it's hard for me to give you a strong opinion in terms of where we go from here. I don't necessarily think the vehicle has grown the way the parent company has wanted it to grow. I'm not sure, though, what their intentions are from here.
Okay, well, let's take a break. Andrew Moffs taking your questions on real estate stocks. And actually, we looked at Andrew's past picks there. There were 3 winners, and I incorrectly said he was previously on June 25th of last year. It was June 25th of this year, 2020. Okay, we'll be right back. 1-855-326-6266. Jason in Halifax, go ahead, please.
Hi, thanks for taking my call. I was looking for Andrew's thoughts
Pleasure.
on Equinix. They're up probably like 80% since their March lows. Is it kind of too late to jump into the data storage REITs, or is there still lots of room for growth there?
Thank you.
Yeah, so Equinix is actually one of the largest REITs globally. Venture, the market cap is over $65 billion. This is a company, as the caller mentioned, focused on the data center space. And no doubt it has benefited through the pandemic, even more so just because of all of us working remotely and the data storage, cloud computing that needs to occur. And these companies like Equinix provide the facilities for all the co-location and storage. This is not a cheap stock. We're value investors, meaning we like to buy companies trading at a discount to their private value. And this certainly trades at a material premium to its private value for good reason. The growth has been tremendous. So will the growth continue? I believe so, but you're going to have to pay a pretty high multiple of earnings for that growth, order of magnitude 40 times. So it's a stock we like to think about buying on pullbacks. And at this point, we think it's pretty highly valued, but really in a great space. It's very hard to knock it. This is certainly the trend. As real estate investors, you can go and build a data center, and it's pretty attractive. If you just deliver the cold hard shell at $150 a square foot. What's very difficult for guys like us to value is the $2,000 to $3,000 of improvements per square foot that operators like Equinix put in. Does that depreciate? Is there a value to it? And so as a real estate investor, it's very hard to get your head around that looking forward. But for now, the cash flow, earnings growth of this company has really been tremendous.
We've got Alvin standing by in Bath. Go ahead, please.
Yes, hi, Andrew and Andrew. Thank you for taking my call.
Hey.
My question is pertaining to Brookfield Property Partners, BPY. They seem to have been struggling for a little bit, but there seems to be gaining some traction as of late. What are your thoughts on it? I'll hang up and listen. Thank you very much.
Thank you.
So, BPY is controlled by Brookfield Asset Management, who's one of the largest owners and operators of real estate globally, really talented management team. The structure, though, of BPY has been challenged. It is controlled by this entity and is a diversified REIT, essentially, that really falls into three buckets. Say 40% of their assets are trophy office buildings, 40% of their assets are regional mall, Class A regional malls, and 20% of their holdings are opportunistic investments. I talk about stability of cash flow. It's very difficult to underwrite the stability of cash flow in this entity. Certainly on the mall side. Whether rent collections have been 20, 30, 40%, it's nowhere near where they need to be, and traffic counts, though they have increased, if we go into a second, as we progress through this second wave of the pandemic, will continue to be challenged, and that in turn hurts the retail sales of the retailers that rent space from BPY. On the office side, there are many question marks about the future of office in the markets like Manhattan, London, Toronto, where BPY has predominant exposure. These markets will continue to be good markets, but the incentives that will be needed in terms of the rents for landlords to give to future occupiers of space will be quite large, and thus we question the value of some of these trophy office buildings, and thus, though people point to the net asset value discount of BPY, the future value may not be as wide as people think. So it's a company we've avoided. It has rallied. They did a substantial issuer bid, which propped up the shares, the units, of the company, but I think has since pulled back.
Let's squeeze in one more caller. Tim in Vancouver.
Oh, hi, guys. Yeah, my question's on RioCan and maybe the similar position as Brookfield's you're just talking about. But, I mean, the stock is trading at half of its value pre-pandemic and paying a yield of north of 10% now. So what's your thoughts on this one? Is it a good value at this level?
Thank you.
Notwithstanding what I said about Brookfield Property Partners, I think RioCan is better value. Yeah, it's hard to believe this company, this REIT, issued equity, I want to say in the $25 range a year ago, and pretty prescient given where stock prices are today. So far, Ed Sunshine, the CEO of RioCan, has said that the distribution is safe and has really made a pledge to continue paying that distribution. And the good news about this REIT is that they've done a great job of really concentrating on the key markets in Canada, and we're at the forefront actually of selling secondary markets. So I think there is stability, at least to this REIT in the near term, and they do have a growing portfolio outside of retail that will have a lot of value. And for now, we think the distribution is safe.
Okay, I'm showing a yield of just over 10% on RioCan right now. Whoa, what a drop in that stock. After the break, we're going to get Andrew Moffs' top picks in real estate. Andrew's first idea, he's sticking with Tricon Residential.
Yeah, we continue to like this company. As I mentioned, it's focused on rental residential in North America with a focus on single-family rental homes in the United States, as well as multifamily apartments in Toronto. If you think about the single-family rental home sector, it has really benefited from deurbanization, the work-from-home lifestyle, as well as millennials now in terms of their stage in life looking for more space because of whether they're having kids, marriage, etc. And so what Tricon offers is a product for the middle market that's affordable, and the ability to own a home in markets at prices, at rental rates that are cheaper than high-rise apartment buildings. And given the environment we live in today, I think there's going to be a higher propensity for people to avoid things like elevators and higher density. And so Tricon, if you look at the valuation of the company, still trades at a discount to its net asset value, despite it operating at really record occupancies, over 98%. We think highly of management. We like their capital allocation strategy, so we're sticking with this as a buy.
BSR REIT, why do you like this one?
So I mentioned this earlier in the program. We're actually one of the largest owners of this REIT. They are focused, just like Tricon, in the U.S. Sunbelt, where you're seeing the population growth continue to outpace the rest of the national average, the rest of the country. You have places like Dallas and Austin are employment centers, and you need employment centers for people to occupy apartment buildings. And BSR is an adept operator, and really the valuation of this company is just so attractive because you have both growth. You have stability because, again, their rent is quite affordable. They also target that middle market. Think, $800, $900 rents, which is highly affordable when you think about other markets across the country, both here in Canada as well as the United States. And it trades at a discount to net asset value, and we think that net asset value continues to grow every year with a pretty attractive distribution yield on top of it. So for us, BSR remains a top pick.
Okay, and then your final idea, Irish Residential Properties REIT.
Yeah, I figured we'd talk about something different. A company that we think very highly of. It's a REIT that was formed by Canadian Apartment REIT, Cap REIT. Spun out of that company several years ago into a standalone REIT on the Dublin Stock Exchange. We see in IRES pretty attractive demand and supply fundamentals in the markets they operate in, which is namely the Dublin market. You have a housing shortage in Ireland at the same time where you're seeing Dublin becoming a burgeoning tech hub. And so the combination of those two forces has caused rents to escalate at a time where there's been somewhat of a rent control. So there's a large mark-to-market embedded in IRES in terms of their ability to increase rents on turnover, as well as increase rents on renewals. So you couple that with, we look at the private market, and we've seen trades in the market for comparable assets to IRES. And if you apply the cap rates where those assets have traded at, call 3 3.75 cap rates, 3.75%. You apply that to IRES, you have a €2 stock compared to where it's trading at today. So quite a healthy discount to net asset value. So we think this is a really good stock down.
Just something you said there reminded me of something. I mean, we're seeing such social change and real estate change as a result of COVID. Yesterday, The Guardian in England said we're seeing the rise of half tourists who go to a holiday spot to work. They're having fun, but they're also working for weeks or even months. So the whole real estate market is being transformed here.
Absolutely. So what makes a company like IRES defensive is that traditionally Ireland, the country, has been a bit of a tax haven for many companies and corporations, and so in order to maintain that status, they need to make their workers, whether they work at Google, Facebook, et cetera, return in some form to that market. And so IRES should benefit from the return of many of those foreign workers that left the country at the onset of the pandemic.
Andrew, we'll have to leave it there. Thanks very much indeed for joining us.
Thanks for having me on.
Andrew Moffs of Vision Capital. Before we go, let's have a quick look at the markets, because we have seen some selling today, or we saw selling earlier on in the broad US market, and still down. The Dow Jones, last time I checked, down around 180 points. The NASDAQ, a little while ago, around the start of our show, was poking its head above the losing line, but now down around 13 points. Not a huge sell-off today. And the S&P 500 down something like 17 points. Crude is hurting, down around $2 last time I checked, holding above, well, still above $38. But we are seeing these rising COVID cases, and deaths around the world. Ontario has reported a drop in new COVID-19 cases, but that follows the biggest single-day spike on record, and hospitalizations have been climbing in Quebec. Worldwide, of course, the death toll rising as well. In parts of America as well, they're still struggling. Investors also set for tonight's presidential debate between Joe Biden and the incumbent President Donald Trump. A massive TV audience is expected for that event, 9 p.m. Eastern. It all kicks off in Cleveland, Ohio. Thanks very much for watching Market Call. We'll be back tomorrow.